A lot of people seem to think that you need thousands of dollars in order to start trading options. And while you do, you might not need as many thousands as you might think. You don't have to risk your entire life savings like the degenerates over on Wall Street Bets. Instead, you can start out with just $1,000 to $5,000 with these strategies I'm going to share with you today. Hi y'all, my name is Greg and I make videos about the stock market and options trading. Today we're going to be talking about options trading with a small account and some of the best strategies I know for this. So to break this video down for you for each strategy, we're going to go over the basics, I'm going to give you a real example, and we're going to go over the risks for each strategy. But before we get into it, if you like this sort of video and you want me to make more options tutorials similar to this, let me know by leaving a like down below and subscribe if you're new to the channel. To start off, let's define a small account because everybody has a different definition of this. Some people call $500 a small account, but I would say that $1,000 to $5,000 is considered a small account. I think that you need at least $1,000 if you want to start taking options trading seriously. My entire portfolio is worth around $55,000 right now, and I was able to grow it from $3,000 starting in March of 2020. The first strategy that I use really isn't a strategy at all, but if you want to continuously grow your account, you're going to need to put money into it. That way you have money to trade options. Even if this is just $100 a month, if you're starting out with $1,000, that's 10% more than you had the month before, and over the course of a year, you'll have twice the firepower. This was the bulk of how I built my account. I was putting in hundreds of dollars per week, and that's how I was able to grow from $3,000 to $55,000. I put $37,000 of my own money in over the last 18 months. If you keep putting money in, you'll have more money to make more trades. And before we get into our strategies, if you want to know what options I'm trading every day, I post all my trade alerts in my premium Discord. You can find that in my Patreon, link down in the pinned comment below. The first and the most risky strategy that we're going to cover today is going to be out of the money calls and out of the money puts. And this is pretty straightforward and really cheap. An out of the money call is one where the strike price is above the current share price for the stock, and an out of the money put option is one where the strike price is below the current share price. The expiration date that you choose for your option is going to be up to you, but just know the longer you set your expiration date out, the more time you give the stock to start moving in your favor, and the better chances you give yourself at turning a profit. I see a lot of new traders buying into out of the money weekly options, and these are super risky because if the stock doesn't start moving in your favor within a few hours, then theta is going to start eating away at your option if you have to wait a couple of days in order to sell it. That means you're going to be at a loss because of theta. Even if the stock doesn't move at all, even if it doesn't go the wrong direction, you're still going to lose money from theta. I would give yourself at least a month until expiration, and the way you're going to choose your strike price is by going a few strike prices out of the money. And how far out of the money you go is going to depend on how bullish or bearish you are for the stock. If you're small to medium bullish or bearish, you're going to go with 5% out of the money, and if you're super bullish or bearish, you're going to go 10% out of the money. The reason for this is because if you're right about the direction for the stock, and as the stock starts to approach your strike price, as it gets closer, you're going to be making more and more money. The value for an option based on the stock price and its proximity to your strike price for your option is going to look something like this. It's a bell curve where when your option is at the money or right at the current share price, that's when the value is greatest. If I think that AMD, for example, is going to go up over the next few days, what I would do here is set my expiration date to September 3rd, a little more than 30 days out, and then I would choose a strike price 5 to 10% out of the money, so it's trading at 106 now. They'll put our strike price between 110 and 115. And again, how far out of the money you go is going to depend on how bullish or bearish you are for the stock. So since I'm buying a call option, I'm bullish on it, and I would say since it's seen a huge rally over the last couple of weeks, I'm less bullish on it. So here, I'm going to choose the $110 strike price. This option right now is going for $355, and if I'm right about the direction for AMD over the next few days, if it starts approaching $110, we're going to make a pretty significant amount of money. If you want to calculate how much money you would make from an option, you would take the delta, which is 0.41 in this case, and multiply it by the dollar change you're expecting for the stock. So we're expecting it to move $4. We'll multiply that by 41 for a potential profit of $164. Pretty good. That's a 46% gain based on the $355 that we invested in this call option. And if you were to continue to get these trades right, that would add up really freaking quickly. But the problem is here, with an out of the money option, if you're wrong about it, you lose everything. For this 110 AMD call, again, we paid $355 to open this, and we could lose that entire $355 if we're wrong about the direction and the strike price for AMD. If we held this option into expiration on September 3rd, and if AMD was trading anything below $110, if this option expires out of the money, this will mean that we would lose the entire $355 investment. In order to make any profit on this, if we held into expiration, we would need AMD to be above our break-even price, which in this case is $113.55. In order to calculate this, you would add the price that you pay for the option, $3.55, to the $110 strike price for a break even of $113.55. Anything above $113.55 will be at a profit. Anything below $113.55 will be at a loss. The amount of loss that you would take on if it was between your strike price and your break-even price will be the break-even minus the price of the stock at expiration. So in this case, if AMD was trading at $111 on our expiration date, we would be taking a $255 loss. In general though, you don't want to hold an out-of-the-money option going into expiration because just like with any other option, theta is going to eat away at the option's value. Theta is a Greek that's responsible for time decay, and this is probably the biggest reason why most people will lose money when they're trading out-of-the-money options. But if you start using theta in your favor with this next strategy, you can actually start turning a profit. Credit spreads are a great strategy for whenever you're trying to make money on theta decay, and I covered them in my last video, but I didn't really talk about how they relate to small accounts. If you're trading with just $1,000, chances are you can't afford to open a cash secure put or a cover call, at least for a half decent stock. Of course, you could use this strategy on penny stocks, stocks under $5, but those stocks are trading at those price levels for a reason. Generally, there's not a lot of interest in them. And whenever there's not enough interest in the stock itself, there's not going to be enough interest in the options for that stock as well. So this is going to mean that you're going to get less premium for that stock, and it's going to be harder to get in and out of your trades. If you're doing this on more well-known companies, chances are you're probably going to be making money with stocks like Apple, AMD, or Microsoft, but the problem with this is these stocks cost over $100, so if you wanted to use these strategies for these stocks, you'd have to have at least $10,000 for collateral. Obviously, if you have a small account, $1,000 to $5,000, you can't afford to do this, but what you can do instead is a credit spread. This works basically the same way as the wheel strategy, where you'll start by selling a call option or a put option, but instead of needing 100 shares or having to buy 100 shares of the stock, what you're going to do instead is buy a call option or a put option against it. Using an example here, if I'm trading AMD stock and I'm expecting it to be above 102, what I'm going to do is start by selling the 102 put just like I would with a cash secure put, but instead of needing $10,200 of cash, I would buy a put option with a lower strike price. The put option that I buy and the strike price that I choose is going to depend on how much money I'm willing to put down in this trade. If I only want to put down $100 for this trade, I'll sell that 102 put from earlier, I'll buy a 101 put, and for this trade, I only need $100 of cash. Whenever I open this trade, it's going for $38, so I'm going to receive $38 of credit up front whenever I open this trade. So over right here, we'll come away with a 38% profit based on the $100 of collateral. And if we kept getting these trades right over and over again, this can start to add up pretty quickly. Over the course of a year, if we continued to get these trades right, and if we did this every month, we would come away with a $456 return. The amount that we would lose if we were completely wrong on this trade, if AMD stock was trading below 101, our lower strike price on our expiration would be equal to the distance between the two strike prices, $1 in this case, minus the 38 cents of credit. We'll multiply that by 100 for a max loss of $62. If we wanted to make up for that loss, we would need to realize max profit of $38 twice, and even then we'd only come away with $14 of profit at the end. But the thing is, you really don't need to be holding these options into the expiration date and realizing either max loss or max gain. A better strategy that I've been using lately is to take 50% profit any week before expiration, and the week of expiration for my option, I'm taking 75% profit. To close this credit spread at a profit, we would do the opposite of how we opened it. So we'd buy the 102 put, sell the 101 put to close this trade, and for this we'd be paying a debit out of our own pocket. If you want to close your options at a loss, you can do that too the same way, but I don't use specific stop losses whenever it comes to credit spreads. My stop loss is more intuition based. When I lose faith in the trade, then I'll close out of it. And the next strategy that I want to cover is pretty much the same as a credit spread, but really it's the opposite. Debit spreads are like the evil twin of credit spreads. It's like In the Money Adam and his twin brother Eric. They're identical, but completely different. With a credit spread, whenever you open your option, you're going to get paid a credit, but whenever you're opening a debit spread, you're paying out of pocket in order to open that trade. With that $38 AMD credit spread from earlier, if we were to be on the opposite end of that trade and be opening a debit spread with the same strike prices, we'd be paying $38 out of pocket. And whenever you open a debit spread, you're going to have the exact opposite assumption as you would with a credit spread. For a 102-101 AMD put credit spread, we're expecting AMD to be above $102 on our expiration date in order to realize max profit. But with a debit spread, if we had the same strike prices on put options, we'd be expecting AMD to be below 101 in order to realize a max profit for this trade. Call debit spreads are the opposite, where you expect the stock to be above your two strike prices, kind of like with playing calls. So So whenever you're opening a debit spread, it's kind of like opening a regular call or a regular put where you're expecting the same direction for the stock, but you're going to bring down the cost of your options significantly, and this is what makes it great for small accounts. If we wanted to buy a plain call option on a stock with a 6-month expiration date, and if it's a good stock, you're probably going to be paying a pretty penny to open that option. But not with the debit spread. We'll use AMD as our example stock again. We're going to set our expiration date to over 6 months out, so we're going to go with March 2022, which is 7 months out actually. And then we're going to choose a strike price we think AMD stock will be above. So I think AMD is going to be above $125, and that's pretty far out of the money and pretty high expectations. But if I'm right, we can make some pretty solid profits. We'll start by selling the 125 call, and then we'll buy back a call option with a lower strike price, and for simplicity's sake, let's just buy the 120 call. For this call debit spread, we're going to be paying $140 out of pocket, and if we're right about this, if AMD is above $125 on our expiration date, March 2022, we're going to come away with a huge $360 gain. The way I calculated this was by taking the difference between our two strike prices, 125 and 120, for a difference of $5 and subtracting the 140 that we paid for this option for a max profit of $360. And the $140 that's coming out of our pocket in order to open this trade is the most amount of money that we can lose. Just like with a regular call or a regular put, you can only lose what you're putting down in the trade. But there is an entirely different risk whenever it comes to trading spreads. Whether it be a credit spread or debit spread, you run into assignment risk. The option that you sell whenever you're opening a spread can get assigned to you on your expiration date, and if that happens and the option you bought is out of the money, you'll be on the hook to either buy or sell 100 shares of your stock. This is why it's never best practice to hold a spread going into your expiration date. And you can even get assigned before your expiration date. And the way you can cover this is by exercising the option that you bought. And in this case, you would buy and sell 100 shares at your strike prices, and your brokerage will cover it for you. Since these options counterbalance themselves, your brokerage will take care of this for you, and you don't have to worry about anything. And now, finally, for the biggest risk whenever it comes to options trading, please, for the love of God, do not put all of your money into options trading. All it takes is a couple bad options trades going the wrong way, and you could wipe out your entire small account. What you can do in order to mitigate this risk is to put some of your money into long-term investments. Buy real shares of real companies. Stocks that you really believe in, stocks that continuously do well. Put money into shares of those companies. How much you put into this is going to be up to you, but I would say you need at least 50% of your money in long-term investments. You can throw the other half towards options trading, but just realize you could lose that entire half of your account. And what I've done is I've taken whatever money that I make from options trading and I put that straight into long-term investments in order to save that up. This way I was able to bring options trading to only 10 to 20% of my account, meaning that I have very little risk. Over the last 5 months, while the market has been all over the place, I've been able to make $1,800 in profits based on $7,500 that I've invested in options trading. That's some extra gains that I wouldn't have been able to make otherwise in the markets, but this is after years of trading and experience. And I'm glad that I had the opportunity to learn all of this and to be able to teach it to you. I really appreciate it. Thank you for making it all the way to the end of this video. And thank you to all my patrons for the support. And as always, remember to stay positive, stay green. I'll catch you on the next one. Bye, guys.